The second stream of the day. I'm back to working on my stock market project. My goal is to basically have something that's just going to spit out what to go long and what to go short on each day. Um, and actually, I'll go over the goals here in more detail. Then I'm going to go over the outline of the project, what I've done so far, where I'm at. This is my most recent portfolio model, so I've kind of am having trouble over 2020. I'm having trouble getting something that doesn't lose money. And so this at least is going positive after staying positive after 2020. Um, so this is the outline for the project. I have two goals. My first goal is uh, to do with making money. So beat the S&P 500 by a significant margin. We'll stay in market neutral. So the S&P goes up on average 6% per year. I want to do significantly better than that, 3 to 4 times better, 18 to 24% per year. And no year should really do worse than the 6% return from the S&P. Um, so that's my goal. Now I'm writing all of this in Python code, so I have a second goal, which is generalizing the code into a repository that anyone can use to create the same models for themselves. So currently, in the repository is code that can take you can put in any features. All the features are technical indicators on the price data. The data has every stock going back to 2011. It's The data set doesn't have survivorship bias, so everything that's been added or dropped out of the stock market since 2011 is in the data set. Um, and I've implemented these methods so that you can train a model. All the look ahead bias, everything's taken care of. There's all these robust ways of examining the model, the performance of the model. And right now I have it so that I'm creating the universe and creating the model all in under 100 lines of code. So if you're interested in that, you can find the GitHub at the link in the description. And if you find it useful, of course, please star the repository, watch the repository, and follow me on GitHub. Um, so this is the goal. I have a good returns model, and I'm working on the portfolio model. The returns model is basically predicting something like returns relative to the market, returns relative to sector, um, something like that. Um, and so I'm predicting the 5-day forward Sharpe ratio. And so I have a really good model for that. I'll show in a second. I'll explain why I think it's good. And the final step is implementing a portfolio strategy. Here's how to size positions based on the output of the model. And then I'm scaling down from external features like drawdowns, volatility of the model, rolling information coefficient of the model, things like that. So I kind of am doing two things. I'm looking into the model to see can I tweak this in any way to make the portfolio perform better, and then also looking at the portfolio to see am I able to tweak this to get it to perform better. So here's the model that I got probably about a month ago now, and I think it's really good for a few reasons. So first off, if you look at the red box, these are the statistics I'm looking at. And I have goals for each statistic. So there's a really low signal to noise ratio in the stock market. So my goal for information coefficient, this first statistic, which is measuring the predictive power of the model, my goal is 0.01 to 0.02. I'm getting 0.047, so it's quite a bit larger. My goal for the standard deviation of the information coefficient, which gives the stability of the model, is 3 to 13 times the information coefficient. You see here it's about 3 times the information coefficient. Information coefficient to information ratio also gives the stability of the model. My goal on a daily basis is 0.03. I'm getting 0.3. And on an annual basis, my goal is 0.3 and I'm getting 2.3. So both of these are larger by about an order of magnitude. And finally, the T statistic, I have a goal of 1.98. I'm getting 3.76, so about 2 times higher. Secondly, when you look at the decile analysis here, this looks perfect. And so what is a perfect decile analysis? Basically, the bottom decile, the bottom 10% is the worst performing. Top decile, 90% and above, is the best performing. And it should be monotonically increasing between, which means each decile is higher than the previous decile. And that's exactly the behavior we see here. So not only is it significantly beating all of my metrics I'm going for, the decile analysis looks really good. And so the final step was to do a walk forward. So instead of one model that's testing from mid 23 through the beginning of 26, let's try a new model for every single year and see how it performs. So in the walk forward analysis, the information coefficient and the information coefficient to information ratio are well above the goal I have for them every single year. So based on this, the previous slide and the results from this walk forward analysis, I concluded this is good enough to move forward and implement a portfolio strategy on. The problem I was having is this: is if I tried to implement a strategy since the middle of 2023, it did really well. That was really easy to do. Very simple strategies were very effective with this. The same is not to be said when I implemented the strategy for the full walk forward. So it was doing really well after about mid 2023, but it went negative from 2016 through the end of 2021. So this is not something that I could implement. I couldn't sit and take losses for 6 years. And so I needed something more robust. Now, what's kind of interesting is there's an inverse thing happening. If I trained the model to do well on the early time period from the beginning of 2016 through mid 2018, you see it does pretty well there, and then it fails or goes flat otherwise afterwards. And so that's kind of the inverse of the problem I just showed, and shows really this is coming down to the model, I think. The model's not good enough. And so basically, if it's performing well at later times, it does poorly on early times. If it does well on early times, it's doing poorly on later times. And I think there are two reasons for this. So number one is the dispersion of the market. You can see here, this is just the dispersion of my universe, which is roughly a proxy for the market. And you see that the dispersion increased significantly right after the pandemic started. So this is for two reasons. One, there were way more stocks. There's a huge boom of stocks listed in 2020. And number two, of course, is the participation of retail traders. So this is one metric by which the regime has changed. We went certainly in 2020, the market became more dispersed. So this is one thing that could be going on. Another thing that could be going on is interest rates. So it's well known that interest rates were roughly zero throughout the 2010s and into the early 2020s. Hey, Eargasm, how are you doing? And since 2022, interest rates have become non-negligible. So that's another thing that's going on. At later times is a high interest rate regime where it's easy to perform well. At early times, it's a low interest rate regime. So I looked at the model and I found a couple of things here. One, obviously, it's not the decile analysis for each year isn't strictly monotonically increasing. And another thing is that it's performing really well. So if you look at the years it performs best, the best years are, say, 17, 19, 21, and 24 about. And so look at the spreads. At 17, the spread is from minus 0.1 to 0.075. 2019, it's from minus point, same thing basically. 2021, it's from minus 0.2 to plus 0.15. 24, well below 0.1 to above 0.1. So you see the years it does really well, there's a high spread in the market. And that makes sense because this is a long-short strategy. Now, if you look, and it seems to be roughly monotonically increasing all of those years. Now, if you look at the years it's performing poorly, 2018, 2020, really those are the worst ones. You see a couple of things. So one, 2018, the spread is really low. So instead of like plus or minus 0.1, the spread here is now plus or minus about 0.03, 0.02. So much lower spread 2018. 2020 again from minus 0.06 to positive 0.02, and not clearly monotonically increasing. So I thought, my problem here isn't just the portfolio strategy I'm implementing. I need a better model. So I went through and I trained this model, but dropped out everything that wasn't an important feature. So all the features that didn't have a coefficient of variation above 1, all features that didn't have a mean importance above, I think I did 0.05. I dropped those out of the model and then retrained the model. And so this looks actually like a much better problem. So my problem before was if it does well on later times, it does poorly on early times. If I get a strategy that does well on early times, it does poorly on later times. That's not the case here. You see, it's basically increasing from 2016 through 2020. So it's doing well on early times. It's also increasing from late 2021 through the beginning of 2026. So it's doing well on later times. It's only struggling in between, really during 2020 and into the beginning of 2021, the COVID regime. So, hey, Soulwater, you're back. You want to play some chess? Send a new light chess link if you want to play in the Discord. And you're up late, man. Yeah, but so basically my problem went from that binary problem was really problematic. It basically showed this strategy can't span different regimes. This strategy spans all regimes from 2016 to 2026 and fails during one of them, just the COVID crisis, which was honestly a very unique event. 2020 was a very unique year in the market. So the fact that it's failing during this crisis, that's a much better problem for me to have. And I can tolerate some loss, but I want to minimize how much the loss is. And ideally, I would be positive after the crisis. So, I trained another model, so the top model is earlier. So I'm training the model right now on 5-day forward sharp returns. Before that, I was just doing 5-day forward log returns, and I found that incorporating mean reversion and volatility features neutralized to I already have them neutralized to the market, but if I add in extra features that are mean reversion and volatility features neutralized to the sector as well, I found the model improved performance. So that's what I did here for the top model. And then just like I did earlier, I dropped out I made this bottom model where I dropped out everything that wasn't an important metric. Had a low coefficient of variation or a high coefficient of variation and or a low mean performance. I dropped those out. And now that increased the performance earlier. So this is the first time I did that. I increased performance, and that's when the problem changed to just this COVID regime problem. However, when I did it down here on this model, dropping out, keeping only the most important features actually worsened performance. And you see this is the same strategy implemented. So this is nice and smooth, a lot smoother than this, which has these jagged pullbacks. And this also goes negative during COVID. So I decided to go ahead with this model. Here's where I'm at right now. So I've been tweaking the model parameters a little bit, but basically with these, I incorporated beta neutral sizing. So before I was doing an equal dollar amount to the longs and shorts. And so one reason this was struggling during 2020 is they call that was called the trash rally that happened after the pandemic crash. And so that we had the big pandemic crash, then we had the trash rally where a bunch of people had stimulus checks and people were just buying garbage stocks. And so at that point, that's going to break this long short strategy basically. Thanks, Soulwater. I'll open it up in a sec. That breaks this long short strategy because now everything is has a high beta to the market, and everything was going up. So even trash stocks that really should be shorted in an ideal world, they're overvalued. If I'm going short on those, I'm getting killed on those stocks. And so that's basically what's happening in 2020. So with that weighting strategy, I was able to mitigate the losses from 60% up to up only about 20% at the worst point. I was doing better than that earlier. Hey, Gianluca. I started a Rumble stream with my bot live learning. What is your bot training on? The stock market? It's live learning the stock market. Um, so let me see actually first because I was using different values here before. So um, maybe I could just make that a 10-day. When I was doing 10-day look back, I think that was doing better. But basically, this obviously that drop is a concern. That would be hard to tolerate. I'd be in crisis mode if I was live with that. Um, so this morning I added this beta neutral portfolio weighting. Scale down exposure with higher total cross-sectional correlation. That's actually not necessary because I'm already using the spread for my model. Those are different ways of getting at the same thing. Scale longs and shorts according to market trend. That would definitely solve the COVID problem, but it would also make the model more fragile. And basically, this is a long short model. Maybe I could decrease exposure. Um, but yeah, that's not going to really do it for me. So, um, now this is interesting. So I do have some things to look into for the model. So, oh, see, here's a really good model, but I didn't write down the parameters. But this obviously looks really good. It spiked to about 100% profit from COVID and then dropped to about a 60% profit in the beginning of 2021. But then it did so well after that. I think actually if I could get this again, I might be happy implementing that. But I don't remember exactly the parameters, so that's something I need to start writing down. Yeah, so I know that I can get the previous performance by tweaking these parameters, but I don't remember exactly how. But this doesn't look too bad. Up to 60%. It's the same thing I had before. So let's see. Target volatility was 0.12 earlier. Drawdown, I'm basically taking off. Never has a 70% drawdown. Use IC scaling, true. Are you concerned about overfitting as you tweak the parameters? Yes, I am. But I have two, if it depends how much I'm gonna have to tweak the parameters. Because if I just use a kind of a first principles thing, um, then I don't really have to worry about overfitting. I'll just go, okay, using best practices, I get a good model. If I need to tune the parameters to get something, basically I could be overfitted to the COVID crash. But basically, my thought process is that the COVID crash is kind of a unique event, and when's that going to happen? Where the whole economy gets shut down and then reopened, and then stimulus checks are printed, and everybody gets free money to invest, and all that stuff's going on with the GameStop, AMC short squeezes. Um, and so if I'm overfit to 2020 and it's still performing well, if I get something that doesn't go negative from 2016 through 2026, I'll be fairly confident that this isn't some lucky portfolio model. This is just the successful way to implement the strategy. If I end up needing to tune all sorts of parameters to get really exact values and the parameters are fragile, then I will have to worry about that. Yeah, so what was I doing here? I mean, the drawdown's not bad. It's at worst it's a 25% drawdown. It draws down from 60% return all the way down to it. Yeah, again, it's the same magnitude every time, like 60% return to 20% return. So 5 longs, 5 shorts, 5-day holding period, rebalance every day. So what if I change the rebalance to 5 days? Actually, I want to start a chess league, no money involved, but I want to have a player auction for 6 teams, and the winners will get points as reward, which can be used in the next auction. I'm already confused. You should start it. See, I'm in. I'll play in your chess tournament, as long as there's no money. If I got nothing to lose, I'm in. Yeah, that did much worse. So 5-day rebalancing does worse. Bigger drawdown, too. Rebalance every day. So what is different here? Target volatility, 0.12. Use IC scaling. Maybe I need a 30-day look back here. Maybe scale down more aggressively. Successful portfolio strategies on model 23. Is this model 23? I keep forgetting. This is model 25. Okay, and then let's go here. There will be 6 captains. Each captain will have a team. Each captain will be given 10,000 points. And what? Then there's a tournament to see which team does best. Okay. Where'd my browser go? Here we go. Alright, this looks better, but still not what I'm going for. Not the worst drawdown. Less exposure. Yeah, it's still like better than that. Alright, let's go. And what, I guess everyone has a rating. Each team will play in the league, and whichever team wins, that team will be given 5,000. Well, that's a good idea, but then quickly, wouldn't there be someone who dominates the league? That team would just keep getting more points. Alright, optimal time period for the model. Macro regime features. Okay, so I'm kind of struggling. Hey, Sir Night Night, how are you? You perfected your edge? How do you know? Were you paper trading or live trading it? Everyone give a congratulations to Sir Night Night. for finishing his strategy. Oh yeah, that's what I was thinking. Team that wins the first time will then just come to dominate. Okay, so I think it would be a good idea to add macro features like VIX and the moving average change of the market as a whole. However, when I tried to incorporate macro level features like interest rates, I'm testing across various regimes. The 2026 regime is different. Well, that makes me nervous because I'm on my way to a good strategy up through the beginning of 2026. So that will be a good test, if I test it on 20. So more volatility is good though, right? But it also means more volatility sounds good. More efficient sounds bad for quant people like us. When I tried to incorporate macro level features like interest rates earlier, the model performed significantly worse. It was concluded that this was because the model target is neutralized relative to the market. Since the macro features were the same for the whole market, the model wasn't able to learn any rules. Is it feasible? Useful rules. Is it feasible to incorporate macro level features without running into this problem? So what do I want to do first, basically? Time period, macro regime features, add short interest. I don't think I'm going to be able to add short interest. I don't know, that sounds kind of confusing. You could end up at endless features. Oh, so that's what I'm doing. Well, I'll join. Yeah, I don't like that technique one. So, um, instead, what can we do? So, currently, five, 20, 60, and 100 day. 5, 20, 60, and 100 day. For each base feature in my model, this seems to work well for 5 days, but I assume things like 5-day look back features will not be useful for a 20-day model. How do I determine what look back windows to use from the length out the target is? For example, 5 or 20 days. Standard framework is to use 1, 3, 6, and 12 times. So for 5 days, it would be 5, 15, 30, and 60 days. 5, 15, 30, and 60. For 10 days, it would be 10, 30, 60, and 120. So actually that oh, I'll be a player, but I'm not very good, so take that into account. So let's try doing a new model. So we can do so let's say model 27. same as model 25, but uses 10-day forward target plus 1, 3, 6, and 12. So 10, 30, 60, and 100-day look back windows. Okay, so now let's do model 27. Let's turn it on here. Hey, this has no money involved, and bad players means more volatility and more fun. Well, good, I'm in. Okay, well, yeah, just keep me updated. You've got one player here. Let's see, did you make a move? Alright, so... 20 days just going to be hard to do. Let's go to model 25. And we can just do the same thing. What is classical chess format? Okay, so the windows now are going to be 10 days, 30 days, 60 days, 100 days. Time period 10. So what model is this again? Model 27. So let's put it in model 27, walk forward. Ten, 30, 60, 100. Yeah, that looks pretty good. Let's make sure that one's on. Okay, so this is gonna run. It's gonna take a sec to run. I'm gonna go grab an energy drink really quick. Okay, so. Mm. Okay, good. It is running Model Explorer. One and a half hours per game. One move per day, yeah, that's hard. Maybe one move every like 6 hours or something. Alright, so how do I organize this? Should be something like, I want to show the decile analysis for every year. Um, hey, well, 2016 looks really good. Okay, but, here it is. I don't know. 1.5 hours is too long for me. I like short games. But look at this decile analysis. I mean, that is very, very good. For 2016, it's never looked that good. So let me put that in and get the performance here. 0.03. So roughly the same range. 30 minutes per game sounds a lot better. Sounds more doable. Yeah, hour and a half I think is too long. Just personally though, I mean, I don't know. I'm kind of a not some chess player or something. But 30 minutes is actually good. 2 30-minute games per weekend. I would do that. Yeah, so look at 2016 here, here. This is the model I decided. Oh no, here's the model that was good enough to use. So actually 2016 looks good here in the better model, but that looked really good. But and in the trimmed model it didn't look good. But let's see what the magnitudes are. Oh yeah, minus 0.06 to 0.04, so roughly similar magnitudes. But this one does look better. Looks perfect, really. Yeah, 30. I think 30 minutes is perfect for one game. Alright, so how are we going to organize this? I guess what is on here? I guess I could copy all of this. Why does that not get everything? Why did that happen? What? How did that not copy? Okay. I'll just put the next one in. So 2016, 2017. Actually, Yeah, that is a lot of people, but I don't know, it seems fun. Just ask your local chess club. Let's see, so this... Yeah, so now it's doing 2018. So, does this look better? 2017 looks good on both years. It actually looks better above. 0.07 minus 0.01. So I think it's better on the previous model. That looks crazy. Hi, Pratham Barakal. Mumbai, isn't that a huge city? How are there no chess clubs there? There must be some chess clubs. This one looks kind of crazy. I think it definitely looked better before. On the 5-day model. Oh, actually, it didn't look good on the 5-day model either. 2018's a rough year. What's the spread? Here it's plus minus 0.04. Yeah, plus minus 0.04. Weird year. Maybe I could do something like take more, spread it out between more stocks and weird years. .02 though for 2018. That's really good for the information coefficient in 2018. That's always a tough year. What? India invented chess. People must play it for fun there. That's crazy. Come on, right? Indians love chess, I thought. Oh, it was .02 here. So I don't know if it's that much better. But maybe it will be more stable in 2020. So maybe I could get a better spread. The problem is the whole time the spread's basically the same. But again, it will be holding for 10 days instead of 5. With each tranche as 1/10, so that will be more stable, you would think. It's in the description, the data source that I use. It's basically this thing. It's called Dolt Hub. It's like GitHub for data, and there's this guy who uploads stock data there, and he has. It's a really good data set. There's no survivorship bias, so all stocks that have been added to or dropped out of the market are all contained in the data set, and also he updates it every single day. So at some point after the market closes, before the market opens on the subsequent day, I've been monitoring it for about 5 months, and he never has missed a day. So I'm planning on using that as my data source. I'm also I I'm basically open sourcing the code I'm using to make all of this. So not the models, but the code to basically generate and test the models, make the plots I'm making here. And so I want that to be some tool that anyone can use, but I want it to be on free data. So because of those reasons, I'm sticking with this data source. But obviously, if I can start making money and everything becomes more sophisticated, basically you can run different uncorrelated strategies. The more data you have, the more data you can pay for. So I'm going to start doing that at some point. But I'm not making any money, and I'm just making free stuff. So yeah, that's my data source, but it's a really good data source, and it's a really nice repository, data repository that guy has. It's extremely useful. He deserves an award of some sort. And if you're interested in the code, you could find that in the description as well. There's a GitHub link. Alright, so this one's almost done. Here we go. So 2019 plus or minus 0.1. It looks pretty good, but the top decile is actually not the highest. So let's compare that to the other model. Also, information coefficient was really high, 0.07. So 2019. Oh, so I definitely did better in 2019. Although it does look perfectly monotonic here. Maybe a slightly higher spread. Yeah, slightly higher spread. So slightly higher spread, not as monotonic, higher information coefficient. So that's kind of the first interesting thing we've seen. Ideally it would be just as monotonic, but since it's better on spread and information coefficient, that makes it pretty interesting. 2020 will be very interesting though. I'm hoping it will look more monotonic. Maybe it will have a higher spread. And what was the sharp or the information coefficient? 2020, just above 0.02. So can I get a higher information coefficient in 2020? The fact that it wasn't significantly better in early years, but it seems better in 2019 is a good indicator, because you know, if it's not better on early years, it's validating on 3 years. So 2016 is really only using 2 years of test data. It actually looks more monotonic in 2016. 2017 it looks slightly less monotonic, but the spread's the same. Top decile is more nicely separated in 2017. 2018 looks like crap, really, in both models. But interestingly, it seems to be good at predicting zeros there in the middle. 2019 looks worse, but has better spread and better information coefficient. So we'll see. Anyway, I think I'm gonna let this run. This isn't the most interesting thing to watch, but I might do another live stream later tonight and go over these results, and maybe I'll run another thing before I go live. And I might just do one tomorrow. But anyway, if you think this is interesting, I work on it every day. So tune in, follow along. Hopefully I'll be able to go live soon. So thanks for watching. Have a good day. Adios.